Hey guys, hi. Yep, going to talk to you about dollar index. This gent North Star done some put some real effort into his charts, and as a result, I'd say give him a follow on his Twitter, definitely. Also seems to be on the right side of the precious metals argument generally. So a lot going on. Give him a follow. That's North Star, North ST. In fact, I'll post this YouTube and copy him in, and you'll see it. And certainly give him a follow and support him. I'm actually going to go through a charts that he's done, and I'm going to disagree, but respectfully disagree, and give a counterpoint. So this is not a takedown or any get your popcorn type fight. It's nice to see people giving a lot of detail in their charts, and I want to applaud him generally, and I want to support him. And I'm going to talk about global currencies because I've been due to do that for a while. So this is more just a trigger for a discussion. So these are his charts that he's presented. So I'm going to just maybe broaden that a little bit more. And I think there's an interest there on precious metals from his side, which I think is the right thing. I'm a macro bull on gold, silver, palladium, the lot. I've actually holding palladium throughout this soft little drawback period, but let's not get too sucked into the precious metals. Let's talk dollar index because this is the charts he's provided. So I also like when guys do long-term charting. People go, oh, charting is for timing, and fundamentals are for, the big picture. Absolutely rubbish. Charting is only for timing if you're looking at short time frame charts. Charting is more relevant. Patterns are more relevant when they've taken years, decades, or months to form than they are when they've taken 5 minutes to form. So if you only think charting is for timing, then it's time to start fiddling with the time valuation that you're watching on your charts. Anyway, I'm not a fan of indicators, but I'm not going to go into at length with overbought and oversold. There's a stochastic on there as well, and he's making the case it's on the high side of the stochastic. So just to highlight where he's highlighted, he's saying that's largely irrelevant for me. During that period, you were in the high side for a sustained period, and you kept going up, you kept going up, and you kept going up, and any shorts taken on those stochastics would have been absolutely deadly for you. But I won't get into an indicator debunk session here. I want to talk about the top half of his chart because price is the most valuable aspect. And I like what he's done about looking at cyclical lows, highs, periods. So what he's in essence saying is these cycle lows over here are coinciding with dollar low events. I wouldn't say perfectly, but pretty much on the money. He's got another cyclical low, and he's identified a sort of uniformity of time frame between them, and then he's projected it into another cyclical low period that is of a uniform time frame largely. This is my understanding of his chart, so I may have misinterpreted. I'm not going to look into gradients. I don't think that's any particular use, to be honest. So I'm going to just bypass those here, but he's looking for similarities, and I respect that which he's seeking to do. If we look at the cycle low, the first cycle low he had, it was 1980. In essence, now you might recall that went with the gold boom. So for people that are naturally precious metals biased at the moment, that's always going to be an important period because it was very high, and that it also coincided with dollar weakness. So they are adversarial in nature generally, but they don't have to be. In other words, and this is an important point I'm going to be coming back to, you can have dollar going up and gold going up for a sustained period. And I think in our future, because at the end of the day, all this analysis is about what comes next for the dollar index and what comes next for us in the future. So the argument and the position being paid is that he sees somewhere between 60 and 70 for the dollar index as a cyclical low somewhere between 2022 and 2028. So maybe 23, 24, possibly 25, etc. So 1980, then he had this period here that's almost smack bang in the middle of 92 to 98. I think that would be probably put you on the 96 stroke 95 element. That was just pre the Asian crisis. that then pumped the dollar. So on crises, this was the 96, 97 Asian crisis, the index dollar is the go-to currency during this history period. Then the gold fizzle, dollar was the great go-to currency, high interest rates, everything, Volcker breaking the back of inflation, etc. Then the Asian crisis here, as I've highlighted what went on there. Then we want to highlight the critical period of 07, 08, 09. So that would be here. The first pump is 08, then a little bit of an easing, then the euro crisis, and then down, and then a push out from here, roughly, in fact, just before the 16, from 14, 15. From 14 as the oil price started to fall. So July 14, 2014, oil collapsed, energy collapsed, and that was the beginning of also China getting exceedingly weak. We had the dollar actually break out of what he's drawn here, a falling wedge. Now, we'll discuss falling wedges as well. Overall, what he is forecasting is not a typical outcome for a falling wedge. So when you have a falling wedge, first of all, so there's fundamental points I want to make on this, and there's technical points, and I'm going to jump between the two. So just recognize a technical argument versus a fundamental argument, and that I will, through virtue of handling all of this, or by tying the news and the events, be discussing fundamentally and then reverting technically as well. So the technical is a sell-off that is indicating to the bottom. Now, when you have a falling wedge, we have what we call the three scenarios. The two most likely is a dip out the low and then a bump to the upside like that. He's actually used red as well. So let me go for blue, and I'll fatten my line up a bit. So it's like that. Whoops, I didn't change the color. I'm using my fat finger because my stylus pen has gone a little bit cranks on me. Let's try it like that. So either like that, first out the bottom and then a cyclical up, or the most common, so I call that type 2, where you do a little dip out the lows, or as it's done here, which is a type 1, it doesn't dip out the low, so I'll change color just to make it recognizable. So it does like that, has a small return move and goes on up. That would be type 1, so that is your low of inside the wedge. And then a rare minority event, although when you have certain circumstances it becomes a much higher probability, is actually a spill out the bottom. So I'll just use the yellow, a sell-off, and that would be like that. And most instances it's a minority event, and in this argument case I would not say it's the highest. So mostly falling wedges bump to the upside. Sometimes they have a final capitulation where they just run the low level. That's what I've indicated with that blue area that I'm circling in the yellow, before they bump. So they have an exhaustive capitulation that violates the low. In other instances, they just break out to the upside. Those are the two of those combined are your majority outcome event. So from a falling wedge perspective, to break out of the falling wedge setup and have a small rally, and then to go all the way down and then revisit the apex, that is not a common scenario technically. First of all, let me just say that. That doesn't mean it cannot happen. Anything is potentially happening. It's just from the templates that we have, and we study wedges, we study constriction event, volatility events empirically. It's one of our core focuses. It's not a common event. That doesn't mean all bull markets last forever when you turn out of it, but you've got to remember that this is a 1980 cycle. This is the top of the interest rate cycle. The weakest bonds have ever been, with high yields required for people to invest in them. And it was the inflationary era post the Nixon's 70s, Vietnam War, and the gold window, and all that went down that led to the gold pump to $800 when a dollar was still a significant currency. So that's the first comment on the wedges. The elements about these watermelon type shapes, I mean, it's kind of, he's trying to identify basing out. I don't fully understand what's going on there, and gradients. He's saying there's a descending line to some degree across there. He's capturing a few of the highs. That doesn't qualify as necklines for me. This is just generally basing out behavior. But he has managed to find two lines that seem fairly accurate, that clip the top, that are equivalent angles. Okay, I don't think you can base much on that. You're not going to necessarily get the same again the third time. So I'm going to just look past that for now. So let's just understand a couple of things about the dollar index. The dollar index is exactly what it says it is. It's an index of dollar being measured against a number of things. So I've got a couple of charts that I prepared for you here. So I went to the CIA's website, where they tell you very few facts and only lies and brain programming. But on certain things like the dollar index, they will give you actual facts. So you can go there. And on their website, on the dollar index, because I have this at mine, but I wanted to refresh my facts, is the following aspects. When you are talking about the dollar index, you are still talking about a dollar against other currencies. It's just a basket of currencies. It's a basket of currencies. Now, everyone wants the dollar to fail, especially if they're a precious metals bull, especially if they're sick of the central banking cartel, as we all are. But that you have to keep your head, though. One pile of poo compared to an even further stinkier pile of poo still makes the lesser stinkier pile of poo a better aspect. Unfortunately, that is what it is. So when you're comparing fiats that all have various problems, if you're saying the dollar index is going to go to 60, as implied here, where it's currently close to 100, you're actually you're saying, I want to be long the euro, in essence. And, I don't know about you, but I can certainly tell you that's not a place for me to be placing money. So the dollar index basket is made up of, I'm going to have to go back to my finger, euro 57.6%. Yeah. You get the yen at 13.6%. By the way, this is old weightings. It should be re-looked at, but then it would make it difficult for virtue of comparison. So they haven't really rebalanced this in a while. Pound sterling at 12% is very high for the British economy and what it once was and what it is today. But it is roughly, if you're going to count the euro, it going on 58%. So let's just make it simple mathematics, 58. And then you're going to put the pound at 12. Guess what? You're knocking on 70% already. Now, the Swiss franc is in essence euro bound. It isn't tied to the euro currency. It has its own central bank, etc., etc., etc. But if it appreciates too strongly, and I'll be showing you some charts about that, it's a problem for the Swiss. So they have a property price boom because they've got set their rates so low because they're sick of Germans, Greeks, and Italians all moving their euros and swapping them for Swiss francs and putting them in Swiss bank accounts because they'd rather hold Swissies than let this European financial experiment play out to its death. Which is exactly what it's going to do, and it'll probably beat the dollar to it. So remember, the currencies collapse from the periphery inwards. It's like dominoes. You've got this tallest and biggest domino that must fall, that is the dollar. Yes, stroke, it can and will collapse relative to things like Bitcoin and gold, but compared to other fiats, first from the periphery they collapse. So the rand, and I'm going to talk about the Asian currencies now in a bit, and the smaller nation currencies will collapse first. Why? Because they've all got dollar-based debt. So if you're waiting for the big reset and the dollar collapse, watch and trade and play all the smaller ones first in the collapse, because the dominoes, it's like this big spire in the middle, which with dominoes keep getting better. You have a circular spire. All these ones on the periphery get attacked first. They fall inwards, and then they fall all towards the central spot for the dollar to fall. While they are falling, the dollar is gaining because it's a binary world in fiat. If you're out of the rand, you're running to the dollar. If you're out of the Korean won, you're running to the dollar. If you're out of the yen, you'll run to the dollar. If you're out of the euro, you'll run to the dollar or the Swiss franc. But the Swiss franc's kind of small and really doesn't want you to run there because they're getting an appreciation problem. Okay, so you've got 58 and 12 with the Britain. Now I've highlighted the pound and the Swiss franc because this is the end of the financial cycle. This reset is about indebtedness. They're trying to tell you about, it's all about climate change. No, sorry, it isn't. The world's been around for 6.5 billion. And even a whole bunch of plastic isn't going to change that. It's going to keep being around. Yes, it could get a bit sick and burp and fart and have to process some crap, but it's going to be around a lot longer. That doesn't mean we must contaminate it any faster than we have to. We want to avoid it, keep it to a minimum, etc., etc. But all these things aside, this is a debt cycle end of times problem. We've gone hyperbolic. We can't have sane interest rates because the debt level is too big. So all these people that are telling you, Paul Krugman, the watermelon communist Zionist per se, is telling you that actually the climate is the bigger thing and carbon stays in the auction and that's why we're going to fail and the debt isn't the problem. No, we don't have monetary policy anymore. The debt is a problem. Let's have 6% interest rates straight away in most of the developed nations again and double digits in the higher risk ones. Let's see how that works out. Let's see how that works out. We do not have monetary policy anymore. It's the end of the financial cycle. Britain, United Kingdom, the pound sterling has become one of the biggest financially engineered nation states as a percentage of its GDP with London. And the Swiss franc has a very high element with Zurich too. The Swiss make a few watches and the other few odds and ends on the side. Yes, very high, strong financial thing. So at an end of cycle, if you are saying the dollar index is going down, you're saying an end of cycle for the financial. Go look at how the pound went after the crash. It was at 2.11 to the dollar. It struck 1.3 in subprime in very short succession. We can show you that chart. That's how being predominantly financial services works out at a debt liquidity tremor, not the end of cycle moment, a major pre-warning tremor. That's how it worked out. So if you think the pound is going to be a place to be instead of the dollar, if you think the franc, I think franc's better than the pound and the euro, but it's going to do its damnedest to destroy its currency because it can't have its currency too strong because it'll have to keep having lower rates and their property prices will keep mooning and the young won't get on and they're going to have all the issues. But they are kind of bolt hole, but not a bolt hole like gold is a bolt hole. And I will show you how much M2 expansion of money supply they have done to counter appreciation in a minute. So you're saying dollar index is collapsing from nearly 100, 99 levels to 60. You're calling almost a 50% decimation. You're calling a 40% decimation of the dollar. Where is it going in the fiat realm? Where is it going? Inside the fiat realm, because if it's going into Bitcoin and gold, it's not inside the fiat realm. Dollar index is not being measured here against Bitcoin or gold or anything not commodity orientated at all. It's being measured against other troubled, problematic currencies that are smaller than it, that are not at the core, and as the barbarians attack the Roman Empire at the fringes, will be the last to fall the dollar. Britain, the Swedish krona, which is also euro bound, add another 4.2 in here. So let's just add 4.2 for the Swedish krona and the Swiss franc at 3.6. You've got 7.8. You've got another 8% here of Eurocentric. Now Britain might leave and be a little bit, diverge a little bit, but Europe sells loads of stuff to Britain and we buy a fair amount of stuff from them. So actually you got 78% staring at you, looking at you. The next biggest that isn't there is the Japanese yen at 13.6. You've got 78%. That is who you are saying is going to put on nearly double. If you're nearly halving the dollar, these all need to nearly double. They're not quite 80%, whatever the case may be, are going to go up. The euro, the pound, and a combination of the krona, which is balls deep in the euro project and proliferation, and God knows the funny nonsense the socialists are all coming up with there, and the Swiss that have been expanding their monetary supply. So first of all, that's what you're saying. Okay, so now that you understand the prerequisite you're making, you need to understand that gold can still go up with dollar going up. You don't need for the dollar to die for the gold to die. That comes right at the end when you go parabolic on gold. That's when all the dominoes in the fiat realm are now fallen, and the dollar is now wobbling as the final tallest tower in the circle, where all the little dollars have all fallen, all the little current fiats have all fallen in towards the middle, and now it's teetering in the middle, and this massive tall domino is about to go. That's when you go parabolic metal. In the meantime, while those things are happening, you're going to get leakage out. Not everything's going to run to support the dollar, but the dollar first gets stronger. Because to stay in payment systems, monetary systems, banking systems, you need fiat still, because people aren't crypto alert enough. And carrying gold around, still not physically practical. And even gold-based cryptos, etc. All the people that want to make those arguments, the take-up isn't there for the amount of trillions that are in the system. Okay, so this is now a fundamental argument that you're hearing. And these are the currencies that you're saying are having to go up if you are buying into this. Now, I can tell you the European banking system is absolutely smashed. So if Greece was a problem, which it was, it is 1/7 the size of Spain's economy, and Italy's economy to Euroland is double Spain's. So Greece is 1/7 of Spain, Italy is twice Spain. Italy's banks, decimated. Europe is broken. End of financial cycle. It's teetering. They're in huge trouble. The people are cheating and lying to try to keep Britain in. The parliamentarians are doing exactly the opposite and doing all they can to resist what the will of the people have wanted and sought. So let's now leave that and go back. So we'll continue with this assessment. Now, I'm going to make this a little bit more global, and I'm going to show you, I'm going to include, in fact, let's choose that one. I'm going to include Bitcoin and gold in this. And this is a chart that's very, very useful. Okay, and this is going to talk to you about why we talk about actually the dollar having a major move against Asian nations, and why I gave you the Korean won as a super long for a multiple, potential 2x with overperformance. And let's get into this and let's understand this. So money M2 is a measure of money supply. And this is all in dollars. So the amount of yuan or renminbi that the Chinese have proliferated at the current exchange rate converted to dollars, this is the number. Yeah? 28 trillion. So China, as a significantly smaller economic player, and the yuan as barely 1% in payment systems. Yes, they've got the big population. Yes, they're going to grow, and yes, they're going to be the future. Currently has, despite the US's proliferation tendencies, twice 28 trillion to the US at 14 trillion. You have all of the Euroland, excluding Britain, at 13.2. Roughly just behind, a trillion behind, or a trillion and a bit behind the US. Then you have what the total world's, then you have the Japanese yen at 9 trillion. So the third biggest economy, and probably the fourth if you're calling China the biggest now, or the second to the US. The second to the US is China. You're going first America, then you're going Euroland, but it's a bit, but China's economy is on GDP on a major debt ramp. So they've rushed to the front of the queue, but the foundations they've laid have been exceedingly wobbly, and we'll talk about this in a minute. So we've got the current situation with China. Okay, so we had Japanese yen at 9.9. The total value of gold at its current price, 7.5 trillion. All the gold in the world that is assumed to be known and accounted for. Now, difficult thing to put a number on. We don't know how much, whether you're getting real numbers out of China and other certain nations. but that's what we think. Okay, pound sterling, 3.1. So cutting to the chase so that this is not too long a clip, the key elements, the pink, all the pink circled area are all the Southeast Asian nations. So you've got just after the British pound at 3.2 trillion, you have both the South Korean won at 2.4 and the Hong Kong dollar at 1.8. You've got the new Taiwan dollar at 1.4. In between it, you have Australia, which is strongly reliant on all these pink nations. So it is, while it's like Switzerland to Europe in a sense, it's fully reliant on the commodity purchasing of the, particularly China, but other Asian nations, and a lot of their immigration as well. So it's an interesting proxy. Japan is part of that Southeast Asia, but I made it in orange because it's slightly different. Its people save and buy its own debt. This is where I differed from Kyle Bass about the yen. He had said they would go to 300 during the period of the yen collapse, where the yen did some QE and they pushed the devaluation of their currency quite strongly, and then it just stopped. And again, it's a fiat currency. So I differ from him on that. But on many of the other aspects around the Hong Kong dollar, how much its M2 supply has grown. It's insane. It's really, really big. It's out of order, and it's going to be one of the big failures. This is why we've chosen the one to trade, but the Hong Kong dollar will also be a similar type scenario. Then you actually go down here in the mid-tier. There is an immense amount of money supply that's been created. The Thailand baht, the Indian rupee, the Singapore dollar, which is a solid Asian currency, but could face some problems from the regional blowback, but probably the safest. Malaysian ringgit. Then you've got the Indonesian rupiah. These are all big. You've got the Filipino peso down here. Total all of these up in M2, and you have a zone there that is very, very highly proliferated in M2. And yes, it's highly proliferated in population as well. But the point being that the currency that they've put out there versus the amount that they're involved in payment versus the amount they're in the payment system. And this is where I need to explain very quickly the dollar milkshake crisis and conundrum is there could be a shortage of dollars. Sounds insane to say because they've proliferated and done all of this debt thing. Because all of these nations have borrowed in dollars, they need more dollars to A, pay back the debt and service the interest. So that creates an external need for dollars in these nation states outside of America, and they can't print them. The only way they can earn them is sending goods to America. So they need massive surpluses trade with America to be sending tons of cheap goods to be paid in dollars so that they can subsidize all this economic hitman debt that's been put on their shoulders based in dollars. And because it's a debt-based system, you need more currency to pay than you actually loaned into existence in the first place. So you loan the first dollar in, but it's got a 10% interest rate on it. Therefore, it needs to be paid 1.10, but there's only $1 in existence. So you keep needing an ever escalating supply of that money. And in our world, it's the dollar. So this is why the dollar goes up when you start collapsing from the periphery, because their debt needs to be paid in dollars, and everybody who's afraid runs to dollars because it's universally accepted in many places, and can be exchanged into euros or pounds or other big currencies if you need it specifically because you're going to those regions. So actually, as we start going into reset, the dollar milkshake theory is the more accurate one for me. There is collapse from the periphery. Where does this collapse start? I'm suggesting to you that it starts with China, Hong Kong, and this whole narrative with Trump and the trade talks is them testing and drilling the collapse of these currencies. How do you bring your 2.28 trillion down so that you're roughly the same as America? Well, your exchange rate has to halve because this is valued in dollars. If the yuan halves in value, they only have $14 trillion in M2. And that realigns all these Asian nations back in proportion to the scale of their economies. You've got South Korea and Hong Kong that is way more than Britain. You add in new Taiwan dollar, you've got the new Taiwan at 1.5 trillion, 1.8 trillion, 2.4 trillion, adding those three nations together. And you've got, you're half of the Eurozone and more. And it's not really feasible. So this is where we're going with it. And these are all fundamental arguments, and it's quite a bull case potentially for Bitcoin down here. Which at the moment is well below that 183 when this chart was generated. You can see how low New Zealand is. They haven't been as an aggressive a proliferator. Australia has had to proliferate. They're killing the Australian dollar because they seek to deflate their housing bubble and take that on the chin in the currency rather than already the 25% dips in headline numbers that they've had to face. So that's another fundamental point to consider. Now, when you're doing cycles, going back technically, the cycle will hold until it stops holding. Cycles don't hold in perpetuity, particularly during this period while you're in a wedge. So this cycling that we've seen that was illustrated quite nicely by the author here is all part of the wedge structure. We actually broke the wedge now. We're going on a new path. The tune doesn't stay the same. It switches to the next song after a while. Yes, you catch the beat after the first couple of choruses, but then just as you're starting to get it and you're bopping your head and stamping your foot and wiggling your ass at the right rate, the number changes. And it's now a different mood and it's a different game. And this triggering event for why the cycle is not likely to be fulfilled, in my opinion, going back down, and I can always be wrong, and this gentleman can always be correct, and fair play to him if it turns out to be that way, would be that we're out of the pattern. So you were in a sustained falling wedge pattern for the dollar index that has held throughout this period. That's why this held broadly, not perfectly, but broadly. That's why this held broadly. And from this point on, once you went out of the wedge, you're no longer in that compression structure anymore. So the cycle is natural to change. And to think you'll break a wedge, but that cycles that were formed while you were compressing in a falling wedge will naturally form, is a massive assumption that I'm not ready to accept. Okay, and I don't think anyone should be. In fact, it's more likely to be a key pivotal point where it changes. So what could happen? Am I bullish to the dollar right this second? Actually, no. In the short term, it does look a little toppy. So let's go, let's check his other chart. He drops into the shorter time frame and he highlights a falling wedge. Now that's interesting because we've done the same too. So let's go and talk about that similar time frame and how we are looking at the market. So there's our wedge. This squeeze event here was a first setup in a new trend for us that gives overperformance. It took you out of the wedge. This is why the secular event of calamity, fear into the dollar, compression down, calamity, fear into the dollar, compression down, calamity 2008, calamity euro crisis, down, squeeze, and then a move up. So we've broken the wedge structure. And when you break the wedge structure, particularly to the bullish side in the first event, that is a turn from this largely bearish lower lows, lower highs event. That means you've transitioned from a largely bearish structure, but that was always threatening an upside break. You've now had a triggering event for that upside break. The cycle is almost certainly no longer going to hold, in my view. So let's watch this a little closer. So you had this broadening pattern, you dipped a little bit lower. This is still a very big time frame. So we take it into the weekly and we talk about where we are now. You had a top, you had a big sell-off and you made a new low. You ran all the lows. What did you do? Immediately you push back up. Are you in a rising wedge right now? Have you had a little pop out? Could you have a sell-off? Yes, it's quite feasible. It's quite feasible to have a sell-off of some scale right now. So in the short term, he may be encouraged by being accurate. So you break out the wedge. Let's draw. Let's not do right clicks. Let's draw. So we break out the wedge at the bottom here, maybe a little bit of a return move and sell off. And then base. And my suspicion is that you have actually transitioned into a major secular bull market in the dollar, where it's largely been bearish since the 80 lows, where you had the super spike into the dollar. It's largely been a series of lower highs, lower lows, and squeezing out lower. So the end of financial cycle has come. Most of the tech is sitting in the US. Switzerland and Britain do not have Schmuckbook and all of these control structure tech, which they're sharing largely with Israel. They're not party to that. And this is a different cycle. The financial cycle will cause a lot of pain in exactly Britain and London, particularly, exactly in Zurich, Paris, and all the financial hubs of Euroland. The Swiss built reputation on banking and privacy. That's largely going out the window. They're gonna have a real headache with that. They aren't going to be all flying at this juncture. So we'll have an easing of the dollar, I suspect, but we'll probably be setting up a continuation pattern that will continue upwards in the future. And I would be shocked to see it run that low, but I would anticipate it to sell off short or medium term. So we can get to 90 from 99 and still be very much on plan for going longer term up and easing. So as Trump gets into his secondary cycle, we can have our Asian crisis, where we will have the dollar be one of the biggest beneficiaries of the Korean won collapse. China are going to need dollars. China are going to need dollars. Korea are going to need dollars. They've fallen out with the Japanese, etc., etc. All of these currencies are going to sell off awfully to bring back into some sense of perspective and of representation of their economic contribution growth-wise in the global economy, where they are overweighted. They're first, they're third, they're sixth, seventh, and ninth, and these are smaller currencies here. So they have proliferated too much money, and those exchange rates, if they rate down against the dollar, we'll see that shrink back more into proportion for their economic contribution and their goods flow, etc., GDP, exports, and all that other aspects. So short term for me, dollar is a bit toppy. It's been making marginally higher highs, which is something we call quite bearish. It's been eking out. It's on what we refer to as a grind line along the lows, marginally higher high, big smackdowns, but then it goes again. So it's a little bit crypto-esque, spike, smackdown, spike. So it's getting near the end. It's getting a bit slashy and thrashy. So it needs a sell-off, and he'll be encouraged by that. But you've had gold going up throughout this period recently, despite the dollar index going up. In fact, all that's happened is gold has gone up even quicker against the other currencies than it has against the fiat. So one of the advantages, they get to hide how much gold is appreciating, because everybody talks about the gold dollar. So having the dollar being relatively strong has actually diminished the real event, the real strength of gold against other currencies. How about gold against the Aussie dollar, for example? Let's have a look at that. How'd you like them apples for a chart? I can tell you how it looks even before it's loaded, because I've seen it many times. Go have a look at it against it's made its upside target for us, most certainly, and it will probably overperform. Let's have a look at XAU, EUR. Do you want euros? How badly do you want those euros? Let's see how gold's done against the euro on a similar time frame. Also in a breakout, made a new high, and it has a pullback. It gets all the support and resistance buyers going long, tricks them, bear traps them out, and then it pushes up higher. It still has the target that I've given to you before. I think it's up at the 1600s level. Quickly have a look for you. Oops, that's not the one I want. Actually, I chose Oanda. That's not the one I've done my draw on. Let's just do that one more time. I'll tell you the euro, because many of my followers will be in Euroland. I think it might be ICE. There you go. So we're just resting at our second interim. We've got a 1686 to come. How do you think the euro is going to be doing, guys? Seriously. And if the euro is doing that badly, how's the dollar index going down against 60% of the basket? being euro directly, and then 12% being pound affected, krona, Swedish krona, Swiss franc. No, you do not need the dollar being the weakest of a bad fiat group for gold to go up. Gold's going up against everything. Gold's going up against everything. It's in a secular bull market. It has got real upside. I will show you and remind you of gold versus GBP again one more time, and a quick look at our targets for that. And again, strong sell-off, but new highs. Trick the support and resistance traders. They all go long on the new high, make them eat a loss. They get shaken out on the down pull. This is classic behavior of our second interim, and our target is at over 1500. Over 1500 and being highly compliant. So it's having a sell-off now. So what? So what? If you were to draw this, if you're in this for the big run and the big game, if you were to draw that, you probably have a perfect little pennant flag and target range. Of course, it's going to have maybe a little bit rest after that has just performed. But that doesn't require dollar to be the weakest of the fiats for very long. Even though I'm saying it may be weak short term and go all the way back to 90, it doesn't mean it's going to 60 because of that. So I disagree with the technical analysis that is being put forward. I respect the effort and the detailing of the charts and give big plaudits and credit for that. Precious metals can go up in spite of them. And in fact, our favorite is palladium, which even through the pullback where precious metals have been gone a little soft, has held its own exceedingly well. And we have, as I've mentioned before, an 1825 target on it, and it's going probably to make that. So let me just get to the daily. I can show you the daily structure and setup. I'm not sure if I've got detailing on here. Yes, I have. 1825 is what we're looking for, and it's just had a little pause at its second interim. So 1822s to 25s for palladium, and it'll be the strongest relatively right now. In other words, gold itself is not as buoyant as palladium. Let's have a look at it against the dollar. So the precious metal bulls will get what they want, but they've got to be patient if they're in gold. Palladium is better right now. Could this be a bit toppy? We warned of a potential head and shoulder structure that could run and you could get shaken out. You've had a pullback, but you didn't invalidate the stop loss of the right shoulder. So if I take that off, you can see it's pulled back here. It triggered around here, and then it's pulled quite strongly back, but stop losses should be right shoulder, and now it's getting soft again. So it's being a bit frustrating, and I don't need to sit in all of that. I'll be in palladium that is stronger right now. Thank you very much. And that's the kind of thing we're discussing in our premium group and the draws we're doing. So there you go. Could be a more sustained period. This head and shoulders could break up, and it could just churn for a while. It's just not particularly interesting, and it's smart to get out once the structure is there. If you're on a medium time frame, on my investment, I'm net buyer. I accumulate every month. Every month I send it through and I accumulate. That's what I call a long-termer, where no buy is a bad buy. Buying into the selling point right now is perfect, providing it's a long-term hold. But for your leverage trading, it's not an interesting place right now for gold. But overall, in the macro time frame, it is. We're in setups, and we've given you the targets. We've given you the targets on these setups across all the other currencies, and you can see it's a natural resting place geometrically against all of them. Okay, so that's just a contrast, a counterpoint, a counter opinion. Precious metals can be strong without the dollar having to fail. I think I made that point, hopefully. Anyway, otherwise I give up. Key things for you to remember. Go to the website, register for the mini-series. You can learn a whole bunch. You will also get our newsletter. Big things coming for oil, and I think bearish, very bearish, and major moves. You can also, don't forget to sub and hit the bell. Otherwise, you ain't going to get these. And you should be following on Twitter at the Market Sniper, at the Crypto Sniper, at the Reset Sniper. All the snipers, market, crypto, reset. And it's always the. Yes, indeed. Okay, I hope you enjoyed it. Share and proliferate. Let's get people understanding technical analysis to a higher standard. And well done to this man for creating a discussion point and some real effort in his charts. And as I say, he still could be proven accurate. I just don't think so. That's my counterpoint to his proposition. Give him a follow at North. Wow, that's a hell of a number. Just look for North Star. And give him a follow for making a real effort to share his thoughts in a detailed fashion. Okay, guys, catch you all later. Thanks. Final appendices that I did forget to refer to that I dug out for you and I didn't include in the initial clip before I was concluding there, that I'm just adding back in. This is how China's M2 supply has gone since 2000 relative to United States M2 supply. So they've caught up and it's superseded by an immense scale. They did a lot of growing for the rest of the world during this 09-010 period where they went parabolic. That's a key chart that you might want to consider. Also, if we look at this chart, you'll see that Switzerland, which is having very low CPI, 0% CPI change, increased its money supply 8%. You can see Switzerland is very far to the right of all the developed nations. So they've been battling to keep a lid on their currency, and they've been proliferating to do so. Despite no inflation, they've been increasing them. They've been increasing their money supply, well, many of them say it's the reason they increase it because there's no inflation. And this is, I expect, to keep a managing element on the Swiss franc not getting too strong relative to the Eurozone. Please note also in all of here, the Philippines, one of the nations I mentioned, India, that has done a lot, Indonesia, that has done a lot, South Africa in trouble to a degree, and China, 2% inflation, but over 12% increase in money supply, year-on-year change. One of the biggest, absolutely inflationary. So what do you think that means for Hong Kong and South Korea, that actually is a gateway nation between China and the West, like Hong Kong to a degree? It's very, very, very negative. So you can see South Korea and Taiwan in the mix there, increasing between 4 and 8%. To the left, just to the slightly more proliferative extent than America and UK. But China is your huge problem. That's going to cause a great deal for such a big economy to be proliferating like that. All these others will be part and parcel of the periphery that collapses in with the loss of when we have our resets and all the currencies from the periphery, from the edges start falling in. So that's an important chart that was of interest that I wanted to show you as well. Hong Kong, why I think Kyle and our view that we had before he went so public about Hong Kong is indeed right regarding the Asian nations. We like it. We're going to express it on the Korean won because it's a slightly more free float and tradable. But the Hong Kong dollar, the M2 supply as a percent of GDP, look how high it has gone. Now set aside Japan, because most of the Japanese people buy it of their own accord and they're desperate to create some inflation. China, very, very big. China, clearly very big. That's one of the big ones in there. M2 supply growing really, really strongly. Let's have another look. The rest of these charts are similar and consulting. You can go grab them from the Wikipedia site. Just wanted to give you those as appendages to this clip. Remember to share, like, and post, and hope that's useful to you. Some of the charts that went hand in hand with the fundamental reason why the East has gone really mad on proliferation, and in dollar terms they're going to need to shrink that down, and the only way is the devaluation of their currencies in dollar terms. Okay, bye for now once again.